Hello and welcome to another educational video from the Traders Academy Co-op, guys. My name is Jordan and today we are going to talk about triangle patterns. They're called the $1 million patterns for a reason, and if you're yet not familiar with this type of chart patterns, I strongly recommend you to watch this video and of course practice, because theory without practice means nothing. Now, before we move on, I would like to invite you to check out the Traders Academy Club, and we have a tradition that on Fridays we hold a live trading room which is public, available to anyone. So stay tuned for the next one, or go ahead and check out the recordings. It will give you a pretty good idea what we do and how we do it in the TAC. Also, don't forget to check out our free Telegram channel, where plenty of educational materials and trade ideas are shared. Now, let's go to the actual subject of this video, which is the triangles. The first thing we need to mention here is that we have three types of triangles: ascending, descending, and symmetrical triangles. Let's start with the symmetrical. Symmetrical triangles could be traded in both directions, up and down, meaning that the direction beforehand could be bullish. All right, we get the triangle and we're looking for breakout to the upside, trading the buys, or the direction before that could be bearish. We get a symmetrical triangle and looking for bearish continuation. That means you probably get it already, but that means triangles, all of them are continuational patterns, right? Because we have trend and we're looking for this pattern to show us the continuation, or to predict, to forecast the continuation of this previous trend. That of course applies to ascending and descending triangles. The only difference here is that ascending triangle should be traded as bullish continuation. So if you have something like that, okay, which will form ascending triangle in a downtrend, this is not reliable. People trade it, I see it all the time, but statistically this one doesn't prove to be holding. The idea is ascending triangle is supposed to be bullish continuation. Same applies for the descending one, where we have bearish trend beforehand and descending triangle forms. Now, what's the difference between ascending and descending? Basically, in this one we're going to find the top boundary of the triangle, creating a flat resistance for us, while the dynamic support is indeed dynamic and it will be moving upwards, trying to close this gap right here and finally meet the other line. All right, in the descending we have the opposite. Bottom support is flat, while the resistance line is dynamic and it's moving lower. So we kind of create this kind of shape for descending and this kind of shape for ascending triangles. That's the difference. You will be encountering two types of triangles. Before that, quickly mentioning here, I almost forgot, that statistically the success rate for triangles is 70% win ratio, guys. This is amazing, right? And this is pure price action. So that's why, again, they call them $1 million patterns. I strongly advise you to check them out. Now, when it comes to the types of triangles, we have 4 points and 6 points, as we have seen in the previous slide. The reason is, the difference is very simple. Here we're going to have 4 touch points, and on the other one we're going to have 2 more touch points. Okay, Many people are also successful with the 4-point triangle, but if you're still a beginner, I advise you to stick to the 6 points at least, okay? Because 4 points could be a bit misleading in times, and from my experience with traders in the co-op, it's better to stick to the more conservative patterns. All right, now let's go ahead and talk about a few examples here, okay? Now starting with the symmetrical triangle in a bearish trend. Here is our trend. This is where a consolidation is happening in the form of symmetrical triangle, and we start counting the points. We get 6 points, okay, with this one here, of course. After that, breakout occurs and we're looking to sell. There are two options when it comes to the protection. The first and more aggressive one, but of course with better risk reward ratio, is to protect the final touch point, which would be right here. Or if you would like to be more conservative, you can protect the previous high which happened. So if we would be counting, right, this would be 0.4 and the previous one would be 0.6 and 0.4. As per the targets, this is what we're projecting, the height of the triangle, and from the breakout zone we're projecting this line right here, and this is how we get the target. Okay, pretty easy, pretty straightforward. Next, we have symmetrical triangle in a bullish trend this time. Trend is bullish, we're starting to get a consolidation, and somewhere at the second part of the consolidation, a triangle forms. Once again, we have the touch points, okay, and after the last one, we can be looking for continuation with the breakout. Same story. Aggressive protection after the breakout zone will be at the most recent low, and if you want to be more conservative, you can protect the low before that. Target the projection of the height of this triangle. Okay, so again, symmetrical triangles could be used in bullish or bearish trends. They're continuational patterns, so at that stage we really don't care what was the direction of the market, as long as we have a good clear market direction, okay, to trade. Let's check out the ascending triangles. Now this one, as you can see, is for bullish trends only, so we want to have a bullish trend before that, and once the bullish trend is confirmed, if you get a triangle and consolidation afterwards, that would be a pretty good call to go ahead and trade it. So pretty much same story. We have the formation, we draw the lines, we wait for the breakout, we project our target, two stop loss levels are available, aggressive and conservative one, and we're looking for the breakout to go up. Okay, next, one more example. This time we have the descending triangle, and you'll notice that this is for bearish trends only. Okay, in this specific example we have two triangles. This one is slightly smaller than the previous one, but it could still be treated as triangle in my opinion. So we have two supports at the bottom right here, another attempt to go ahead and break lower, but look what happens. So if we start counting, you'll see that we have 4 points already. So if you're trading 4 points triangle, 2 of each side, that would be already your trigger for the entry, right? Which would mean this is your stop loss, so that trade would still make money. If you're waiting for 6 points, that means you need to see one more spike to the upside, creating and confirming the 6th point, and only then looking for the breakout. So This one paid fantastic. I didn't put here the stops because it would be too cluttered on the chart. Same story is happening with the next one. Okay, we count all the dots, we do the projection below, and we are looking for the spike. 2 stop losses available. All right, so what's left here is to do a small tiny summary about the triangles, guys. First, they're very, very easy to be identified on the charts. Okay, if you have difficulties identifying triangles using candlestick patterns, which is this one, just switch to bars. That might help you, okay, when it comes to this point. No additional strategies or knowledge is required to trade triangles. Why? Because triangles are purely based on price action. Okay, so perfect even for beginners, especially when it comes to 70% win ratio based on the books and the statistics, which is this one, of course, the high success rate. It could be also an additional strategy to your current trading strategy. What do I mean by that? You're looking for, I don't know, some sort of trend line breakouts or channels or whatever it is, and you start trading it, and this is your first entry. Then you see ascending triangle forming here. Why not add more positions to this one? Right, so it could easily add more pips and profit at the end of the month by applying them to your current strategies. They are perfect because they could be traded literally on any time frame. I do have friends traders who do that successfully even on the 1 minute chart, but if you're a beginner trader, try to stick to the higher time frames, guys. Okay, don't jump immediately to 15-minute or 30-minute chart. Look at the 1 hour chart, 4 hour charts and above. That would be my recommendation, because on the higher time frames things are happening slower. You have time to consider your setups, plus much more reliable. You could trade it on any financial instrument, and that's the best part, regardless of whether that could be forex, stocks, indices, cryptos, whatever it is, could be applied there. Okay, so that would be all for this video. Once again, you're welcome to check out the Traders Academy Co-op, where me and Vladimir are holding live trading rooms on daily basis. Once again, guys, Friday is an open session, so you're welcome to drop by, say hello, check out our work. I'll be happy to see you there. Plus our free Telegram channel, don't forget to check it out. It's absolutely free, plenty of free content there. These links will be posted below. If you like this video, please like and share. Thank you for your support.